All right, guys, we are live. It is the June webinar. We're going to talk about passive multifamily investing in today's market. So if you're on for the first time, check out the chat box. It should be on your right side. There should be a chat icon. Just click that. If it's on your phone, it'll be below. And so just check in and let me know where you're dialing in from. All right. So I'm currently in Williamsburg, Virginia. Brunson, where are you?
I'm in Pasadena, California.
Nice. Dan?
Columbia, South Carolina.
Nice. Frank, how's it going? All right, just checking in and let us know where you're dialing in from. Today we're talking about passively investing in multifamily. Really excited about our June live webinar. It is at a minute after 8 a.m. Eastern Standard Time. Hey, Ben, how's it going? Angel, what's going on, guys? Hey, Antonio from Raleigh. Hey, there you go. Got San Antonio. We got Charlotte. That's awesome. So we're going to kick it right off. As you guys know me, I don't dilly-dally too much around. We've got to start right on time. If you're late, you miss out. Here's some ground rules here, okay? We got the chat box on. We're going to have an extensive Q&A after this session. We're going to talk all about passively investing in multifamily in today's market. We're going to have a chat on, and which means you guys can chat away. If you guys are not nice to each other or nice to one of the presenters, we're going to kick you out with any kind of warning, all right? So that's where we're going to do it. We're going to have a full Q&A at the end. And really excited about today's episode because we're going to talk about what it's like to passively invest in multifamily. We're going to talk about stocks and bonds and real estate and what to be careful of, what kind of returns you can expect, and really looking forward to it. And I want to introduce to you two guys. One is Brunson Hill. He's our Director of Investor Relations. And I'm going to turn it over to Brunson because Brunson is going to moderate this webinar. Really excited about that. Brunson, why don't you introduce yourself real quick, and then maybe we'll have Dan do the same thing.
Awesome. Well, gentlemen, really excited for everybody who's joining us today. My name is Bronson Hill. I live in Pasadena, California. I work with Michael at Nighthawk Equity, so we work with passive investors and raise money for deals. And I run a large meetup in Pasadena, California. And I'm also a multifamily investor. So super excited to be with you guys today. It's really amazing to have two of some of the best minds in multifamily investing and to be able to ask questions, and for you guys as an audience to be able to chime in and ask questions as well. So I wanted to just say something to everybody right now and just say, you could be watching TV right now, you could have been working late, but you made the decision to work on your education, and you're going to learn a lot of things tonight. You're going to be able to ask questions. You're going to be able to really improve yourself as an investor. And so really excited to have everybody here. So why don't we, Michael, did you want me to read through some of the stuff about each of you guys, or would you rather have Dan just introduce himself?
No, I would just have Dan. I think most people kind of sort of know who I am, but have Dan, for people who don't know Dan.
Yeah, sure. So I'm Dan Handford. Thank you, Michael, for having me on here, and you as well, Brunson. Looking forward to tonight's webinar and sharing a lot of information. It's nice when you can get two people together and really be able to provide a lot of value to both of our audiences by doing a webinar like this, and really collaborating a lot of our efforts. And my background is primarily in the business sector, and so that's where a lot of my net worth and liquidity has been built up in. And really, when I started making lots of money inside of the business sector, I needed a place to be able to reduce my taxable liability, and multifamily real estate investing was that ticket, if you will, and that avenue. And so tonight we'll go through quite a few things about that piece of it, and then some of the tax advantages and things like that, amongst a lot of other different topics around passive multifamily investments. My group is passiveinvesting.com. I'm one of the managing partners. We have 3 people in our group, but I'm one of the main, I say one of the main, there's only 3 of us, so you have to be at least one of the main, right? I'm one of the managing partners for our group, and last year we did a little over 130 million in acquisitions, and this year we're on par to do another 120. So very active in the multifamily space and investing, and looking forward to providing a lot of value tonight with the webinar.
Awesome. Michael, did you want to say a little bit about yourself and your investment experience, and just for those who don't know who you are?
It occurs to me that I think some Dan and some of your audience might be on as well. So yeah, so apologize for that. So I am the founder and CEO of Nighthawk Equity, which is our investment firm, and we own just about over $30 million in assets that all through the United States. Really, we're also one of the leading authorities on teaching other people how to purchase apartment buildings themselves. So my mission to help people become financially free, both as an active investor and as a passive investor. And tonight, of course, we're going to be talking about the passive investing side, because what's really exciting about this is that you can achieve the same goal in two different ways. One is actively investing and syndicating, finding deals, raising money. But also the other way, which we're going to talk tonight, is actually passively investing in multifamily real estate.
Awesome. Well, gentlemen, we're going to go ahead and jump into it here in just a sec. I just wanted to remind our audience that we're going to allow for some questions at the end. So if you hear something and you're like, I don't feel like I really got a good answer to that, or something else I'd like to ask, just go ahead and make a note of that, and we're going to come back to it at the end. So let's go ahead and get started. So we'll start with Michael here. Michael, what's wrong with the stock market, and what can people do about it?
I did a study recently, because I was trying to debunk the stock market as an investment. And most people, invest in the stock market because they feel like, hey, someone else should really manage my money for me. And that's fine to some extent. I think as we get a little sophisticated, we realize that maybe our financial advisor is not the best equipped to do that for us. And we're going to talk about that here today. But I kind of studied the returns of the stock market, and I discovered that over the last 15 years, so from 2004 to 2018, the average annual return was 7.04, so it's called 7%. And so that was a return, which doesn't sound so bad, but there's a couple of factors that you have to figure into this stuff. And so I want the listener, and some of you guys may know this, some of you may not, but for example, the volatility market, actually volatility crushes your returns. So while the average return was 7%, if you average out all the returns over the years, if you actually plot what you would have made if you invested $100,000 in 2004, and what you would have had now based on the ups and downs of the market, it actually wouldn't be 7%. It would have been 5.6%. And that's because when the stock market goes up and it goes down, it decreases the principal. And so the next year's return is now in a lower principal. So the actual return, if you invest $100,000 15 years ago, was actually 5.6% return. Then there's the fees. As you guys know, mutual funds typically fees between 1% and 2.5%, and ETFs or index funds are less than that, about 0.5%. So if it were just 1%, it reduces your overall returns from a 5.2 to a 4.5% return. And let's not forget the taxes, because we're actually taxed, right, on our returns of long-term capital gains if you hold it for more than a year, and that will then take down the return from 4.5% to 4%. And finally, let's not forget inflation. Inflation is a silent killer. The Fed actually on their website publishes a target inflation rate of 2%, which means that every single year they want your hard-earned dollars to be worth 2% less every single year. And that is how we define economic growth. And so if you apply a 2% factor, it reduces your stock market return from a 4% to 2.5%. Okay, so in your mind, you're thinking I'm getting a 7%, and maybe you're doing a little better. Maybe your financial advisor is just a whiz, and they're getting 10% over the last 15 years. Okay, those returns are actually more like 2.5% because of volatility to the portfolio, because of taxes, because of fees, and because of inflation. So that, Brunson, is what's wrong with the stock market.
Wonderful answer. Thank you. You summed it up very well. So kind of adding on to this, Dan, can you tell us what about real estate investing, and what are the options people can do to get involved?
Sure. So there's several different options when it's related to real estate. You have your single family rentals. You have even these single family turnkey rentals, and then of course you have commercial real estate. And we're going to dive a little bit deeper here in a little bit on some of the pros and cons between maybe doing a single family rental versus turnkeys and various things like that. Some of those pros and cons. But as far as the commercial real estate, one of the things that people ask me, I get pitched things all the time. Even today, I was on a call with an investor that had a deal out of Pennsylvania, and he wanted me to look at a project to see if I was interested in possibly partnering with him or investing in a large multi-tenant commercial building, and so there's one of the biggest things that I told him about that is that one of the first types of assets, in my opinion, that you see when there's a downturn or some sort of a correction in the economy to get hit is going to be your retail office space. It's going to be your business office spaces where you're going to have these multi-tenant stories. Obviously a little more safer of a retail or commercial would be, your medical office space. And then, of course, inside that commercial space, really there still is that multifamily real estate investing inside of that commercial space. But I kind of like take it outside of even those three categories of the single-family rentals, the single-family turnkey rentals, and then the commercial real estate. Kind of take it out on its own little category and call it kind of like that multifamily real estate investing, because I feel like it really needs to have a category of its own. But other types of assets within commercial real estate are, to me, just a little bit too risky, because this asset that this one gentleman was showing to me today, it had some really good numbers to it, and I told him, I said, well, it looks good today, but the first thing that's going to happen when there's some sort of a downturn is some of these businesses are going to start to go out of business, and guess what? You might have a leasing agreement in place and maybe a personal guarantee, but it's kind of like squeezing blood out of a turnip when you try to have a business that goes and files bankruptcy. There's really nothing to go after. And so you're really just stuck there with the property, and hopefully you can make the debt service so you don't have to sell it at a loss or be forced to sell it, because the banks, are wanting to get paid their money. And even sometimes, even in the multifamily space, if a property starts to be underperforming and outside of where the debt terms are, they, according to some of the loan documents, they can force you to sell. And it's the same thing in commercial real estate spaces with the retail side, as well as the multi-tenant, larger, high-rise or mid-rise buildings and stuff. So I think for this particular conversation, I think those are some other options out there, and there are some people that have made quite a bit of money with those other options. But I think for most of my investors that work with our group, they've started in real estate investing in maybe say single family homes or some of these single family turnkey rentals, and what they figured out is that even if they bought one home a year or two homes a year over the next 20 years, you look at those numbers and it's just not big enough for what a lot of these investors want to have. And so that's one of the reasons why, obviously everybody who's on this is interested in that multifamily real estate space.
Yeah, absolutely. I just want to remind our audience, if you have questions, just go ahead and hold your questions till the end. We're going to have time for that at the end. So just keep those questions. We're going to have those at the end. So the next question is the pros and cons of investing in single family rentals or turnkeys. Dan, you kind of touched on this. Michael, could you just talk about some of the pros? Why would somebody want to do single family or turnkey, or what are some of the draws that people have to that market?
Yeah, I mean, most people, when they're thinking real estate investing, think single family houses. And it's just because that's when everyone in the real estate investing, meetings they go to, that's what they talk about. And maybe some of their friends have done it. They have maybe a rental here and there. So people gravitate naturally towards single family house investing. So one of the advantages is that it's in people's comfort zone, right? They understand they can buy a townhouse or a rental. And so it's something that is easy for them to do. It's also less of investment. The down payment is significantly less than, say, a multifamily, again, within the comfort zone. And sometimes people feel like it's more in their control. And you have, being a landlord, you obviously are in control. You own the building, you operate the building. If it's a turnkey, you own the house, but you've outsourced the operations to presumably a good manager. So you feel like you have more control than you might have if you're passively investing. So those are some of the advantages of single family house investing.
Right. Dan, did you have anything else to add? You kind of touched some of the cons. Is there any other thing that you want to add to that before we move on?
Yeah, I mean, I think, which is kind of inherent in trying to do these types of single family homes or rentals yourself. Obviously there's groups out there that you could join that you can possibly do some of this stuff, passively, but really it's right now when you look at that, it's not really passive. So you're having to put a lot of sweat equity into trying to be able to build up your portfolio of these single family homes. And, when you start to look at, trying to recession proof your portfolio, if you have an asset, let's just say you start off with say one, or maybe let's just say you have two, single family rentals. Well, if there's a downturn in the economy and you lose one of those tenants, you're going to go from, 100% occupancy to 0% occupancy, overnight. And a lot of times, when you're talking about these single family rentals, things that people don't think about is all it takes is one HVAC unit or one water heater to go out, and it can eat up all your profits and your cash flows for that year or even into the next year. And so you have to really plan for that. And so one of the nice things about, multifamily real estate is that you can now spread those expenses and spread that over multiple units. So you're not just having one tenant leave and all of a sudden you're just dropped to 0% occupancy, or even if you have a portfolio over 5 or 10, it's a little bit harder order to scale that way as well. And so obviously those are some of the major, downsides or cons, if you will, on some of the single family rentals with the lack of, economies of scale and being able to utilize some people who are, on the property managing that asset on a day-to-day basis too.
Thanks for sharing that. It's been my experience as well. They seem to be like they're not going to be a lot of work. It's going to be this passive investment, and it's anything but passive. So thank you for sharing that. So let's talk now the advantages of investing in multifamily syndication. So Michael, would you start us out with that?
There's a lot of things I love about multifamily. I think Dan's in agreement with me. One of the ones is, we sometimes talk about the returns and stuff like that, but really we're concerned about the downside. Which we for a lot of us, the recession is fresh in our mind, and we want to know, how do these things fare in a downturn? And one of the things I love about multifamily is how it performed in the last recession. So, for example, residential, we had, for all the government-backed loans, Fannie, Freddie, all the government-backed loans, we had a 4% default rate at the height of the recession. In comparison, multifamily had a 0.4% default rate. And that includes California and real estate in Florida, the hardest hit ones. And if you study those further, it includes people who bought without cash flow, and they were counting on appreciation and got like these 3-year interest-only ARMs, okay? Then they couldn't refinance this and sell, and they lost them in foreclosure because they couldn't ride it out. Now,
you have to forgive Michael. He's broadcasting from a hotel, so he's got some internet issues there. So we're going to I'll kind of talk a little bit more about some of the other advantages of multifamily syndications and investing in those things. And one of the major benefits is obviously what he was referring to is the performance of the market and the below average risk and stuff like that for these investments. And with the returns on these, the same thing applies, is that you have that capital preservation in play. So right now when you put together a project or these types of syndications, we have these projections that are out there, is that with our group, and I'm sure you guys are seeing similar things, we're usually anywhere between about a 15 to 18% IRR. Lately with some of the returns and some of the pricing of some of the various assets, it's kind of going down a little bit, but 15 to 18% is what we generally try to target. And one of the nice things is that, if for some reason there is a downturn in the economy, if I say if, but it's really kind of when that occurs, we don't know, it's all speculation at this point, but when that occurs, investors obviously are going to understand that those return numbers are going to go down because of some sort of a downturn of the economy. But what's the nicest thing about this, and the low default rates that Michael was referring to here, is that you have capital preservation in play. So if you put your money into the stock market, a lot of people lost their money overnight, and they didn't have a chance to be able to exit before they lost all their initial capital. And with these types of investments, with a good operator, with safe, sound practices of getting into these assets that are performing assets that can really provide some cash flow for you, even if you have somebody that comes in and say they're projecting 15, 16, 17% IRR, if they, in this downturn, get down to say 5, 6, 7% in a downturn, I mean, that's pretty good. And so you have a lot more of a buffer, I feel like, in these multifamily assets to be able to achieve that capital preservation, which is really what you're looking for.
Yeah, thank you, Dan. Michael.
Yes.
Do you want to add on there, Michael? Yeah.
No, that's it. I think it looks like I lost you guys a little bit there, but again,
Okay.
one of the things we're concerned about is how it performs in the downturn, and it performed remarkably well. If you look at all the other asset classes, residential, default rates. I think, Dan, you mentioned earlier, office, retail, all these guys did not perform well in the recession. And so now, for example, mobile home parks obviously is recession-proof to some degree, self-storage as well. We prefer multifamily, but from a recession-proof perspective, multifamily performed extraordinarily well in the last recession.
Great. Actually, let's go to this. Let's talk about passive income. Maybe, Michael, you can touch base on passive income. Kind of the passive.
Well, one of the advantages one of the advantages of multifamily is that, unlike the stock market, it actually produces cash flow. So depending on who you're investing with, it's either monthly or quarterly cash flow. Unless you're selling stocks, unless you're selling puts or calls, you're not really generating cash flow from your stock portfolio. So it's a very unique thing. You can invest in oil, for example, that generally doesn't generate cash flow. If you're investing in development projects, it does not generate cash flow. If you're investing in precious metals, it doesn't generate cash flow. So one of the unique things about investing in multifamily is that you can actually use it to pay your mortgage, and we love it.
Yeah, and kind of along those same lines of passive cash flow, it's nice to be able to have that passive cash flow and that passive income, and then also take advantage of not having to pay taxes on top of that cash flow that you're actually taking in. And for certain people, depending on their tax classification, they have the opportunity to possibly even offset some of their other income, so their other either passive income or even ordinary income, depending on their tax classification. And obviously, I'm not a tax advisor, an attorney, or a CPA or anything like that, so obviously check into that very closely with your particular team. But one of the nice things that I've enjoyed myself personally is reducing my taxable liability. Instead of writing six-figure checks to the government, being able to, even this year, I'll pay very little, if not zero, in taxes, based on all my other investments, as well as my I have 5 non-surgical orthopedic medical clinics that I own 100% of, and I'm producing cash flow off of that, as well as some other businesses that I have as well that continue to provide me cash flow. But now with these multifamily assets and being able to do some very special things on them, which is called cost segregation, which allows you to be able to hire an outside engineering firm to be able to piecemeal the property down to the sheetrock and the studs and the appliances and the countertops and the flooring, and really being able to accelerate that depreciation on that asset to those first 5 years. And then something very special we can do right now, which is the bonus depreciation, which is what allows us to be able to offset the expenses of renovation costs that first 12 months while you're into the property. And so that's also one of the reasons why when our group puts together a project, we try as best we can to be able to get those renovations done in those first 12 months. We just acquired a property recently, it was about a week and a half ago, and we've already ripped apart a unit and already are about to ready to put that unit back together again, and then start that cookie cutter plan for all the rest of the 143 units that are in that particular asset.
Sure. Michael, can you talk about the inflation hedge that multifamily is versus other assets?
Yeah, let's talk about inflation, right? Because stocks are very poor performers in inflation as well as savings, right? Because inflation eats away at your savings, anything you have in a bank account. A great hedge against inflation, of course, is precious metals. It's the greatest inflation hedge there is. Of course, there are other disadvantages of precious metals, but it's a great complement to your portfolio. With regards to multifamily, if you apply, this is the interesting thing, you apply a 2% inflation to multifamily. So let's say your rents go up by 2%, and therefore your expenses also go up by 2%. If you map this out, okay, you will see that because your rents are typically, your income is higher than your expenses. The 2% inflation increases the span between your income and your expenses, your NOI. As 2% inflation is applied to both the income and the expenses, your NOI actually goes up over time. And if you plot this in a spreadsheet, because I'm a numbers guy, as you guys know, we plot this on a spreadsheet. Actually, what happens is a 2% inflation rate results in a 10% return on equity. If you do nothing else, there's no value add, nothing else, you just let inflation take yours, you actually get a 10% return on equity. It is amazing. Therefore, investing in multifamily passively is an amazing hedge against inflation.
Thank you. Let's talk a little bit more about the difference between passive and active investing. Dan, would you handle that topic?
Sure, yeah. I mean, when you're talking about investing, especially in this particular topic of multifamily real estate investing, obviously you can be on the active side, where you're actually putting these deals together and actually finding the deal and doing all the legwork. And then you can also, of course, be on the passive side, which is kind of the topic of this particular webinar tonight, is these passive real estate investments. But one of the things you have to think about is, if you want to be a passive investor, you have to ask yourself, what are some of the goals that you have as an investor? Are you looking for that passive income that you can take some of the wealth that you've created over your life and being able to invest it in some of these types of assets, and with good operators like Nighthawk Equity, as well as PassiveInvesting.com and our group? Or are you, but in addition to just the passive income, are you wanting that consistent and that consistent return that will be associated with a low risk profile type of investment or low risk profile type of portfolio? And then, of course, the final thing here is to figure out, are you trying with your investments to be able to build generational wealth? And for me, that to me is probably the number one thing, because I have some money that I'm going to be passing on to my children as I pass on, whatever that may be. I still feel like I'm a little bit of a young buck, but I feel that that's the main reason why I like these types of assets, because as we get into each one of these investments and we were able to exit each one of them and being able to do certain special things like 1031 exchanges and deferring even more of that long-term capital gains tax to the next property, it allows you to continue to snowball and build that generational wealth. And one of the things that I am looking forward to doing is creating some form of what is called an educational a legacy, if you will, for my kids and my future generations, where I'll be able to provide education. I'll be able to pay for the educational expenses for not just my own kids and their children, but their children and their children and their children, by building this what is called generational wealth. And if that's something like that you are interested in, and you're not wanting to do the active side of things, obviously that is what those passive investments are for. And so to me, one of the biggest pros of having that passive investment and being a passive investor is to be able to go and do what you want to do, whether you're working a job right now and you don't have the time to be able to divert it, whether you're an engineer or a doctor, or maybe you're in some sort of other type of profession where you have some money, but you have this FOMO, this fear of missing out, and you don't have the time and the energy to be able to invest yourself and go find these different assets and acquire them, but you want to be able to align yourself with some good operators like ours and be able to put your money to work and not let it just sit there and accrue at a very low amount. And so that's the biggest thing I think from as a pro is concerned. And then obviously some of the cons of it is that you don't have as much control over your assets, because you're giving the operator, the sponsor, or that GP, you are giving them the full license to be able to manage and control that property, which again is one of the reasons why you want to vet your operators very carefully. You don't want to just invest with anybody. You want to make sure you interview them. You ask them some questions about various projects that they've been in and various returns that they've provided, and if they're able to, one of the things you can do, I also ask for is ask for some references of some people that maybe have invested in some of their projects, and how they respond to you, and how communicative they are, and how clear and transparent they are with your investment and with some of these investments. And so that kind of helps to mitigate that inability to have control over your investment, because you are giving the money to an operator and saying, hey, I'm trusting you with this money, please go take it and double it, if you will, over the next 4 or 5 years. And so you have to make sure you trust that person. And so as a passive investor, I don't feel like you're ever going to invest with our group or even Michael's group if you don't know, like, and trust us. So one of the most important things that we can do as operators is get people to start to know us more. And so that's one of the main reasons why we do these types of webinars and provide a lot of content with the value that we're providing with the educational stuff that we do, is to get people to start to know us more, because people will never get an opportunity to like or trust us unless they get to know us. And so that most important thing of that triangle of what I call the investor triad is getting people to know us more and more, so they can have that opportunity to like and trust us. But I'm sure Michael has some people that have probably followed him before that don't like him, just like me. So there's going to be people that will start to get to know you and they won't like you, and that's okay. But you have to be able to get out there and get people to start to know you more, so they can get to that point of being comfortable to invest. And you as a passive investor also have to, when you're interviewing people, interviewing other operators, making sure that you feel comfortable investing with them and making sure that your investment is safe. So obviously, that's probably the biggest con that I see of doing a passive investment. But obviously the pros is you don't have to do anything. You put your money out there, you get to see it grow, and as long as you choose that right operator for it.
Thanks, Dan. I know a lot of our audience feels like they need to choose. I need to be a passive investor or an active investor. Michael, can you talk about maybe some of the advantages, pros and cons of active investing, and why someone would choose that?
Yeah, so active investing is obviously you are the entrepreneur. You're finding a deal, you're analyzing deals, you're making offers, you're raising money. So you're doing stuff. I find that the people who are doing the active investing tend to be people who don't have the capital and they have some time on their hands. An active investor still has a full-time job. We find, though, that people who tend to be more of the passive investors have very demanding jobs, a lot of responsibility, possibly some travel, but their incomes are very, very high. The other thing we're finding is that while people may want to be active investors, the advantage of active investors is that you're obviously more in control of the investment yourself, and you can, quote, make more money with it. The downside is it costs a lot of time and investment. You have to educate yourself, and you have to go find deals, or you have to find investors. A lot of passive investors have more money than time, right? And so they're really looking to ways to leverage what they have, which in this case is money. There's overlap, though. There are people who want to be active investors, and they consider investing passively as a bridge to get to the active side. And that may or may not happen, right? But the point is there's a lot of overlap. And the other point is that you can achieve the same goal by actively investing in passive investing. So you get equity in a deal, and you get passive income, and you can generate wealth. But again, passive income for some can be a stepping stone into active investing.
I was gonna say, yeah, I would probably dovetail that as well, and just kind of reiterate that fact that sometimes you get questions probably, Michael, I'm sure, about which is better for me. Should I be a passive investor or should I be an active investor? What's the best situation? And I think you're right that it really depends on the investor. But I think a lot of people, I feel like, should start by being a passive investor, because that's what I did. And even today I invest in other deals outside of just my own. And so I'm a passive investor in an LP on some projects, and of course I'm also putting together my own projects. And so, for right now, I think that if you're thinking about you're starting investing in multifamily, start on that passive side. It's one of the easiest ways to get started, and it'll also help you understand how you want to treat your investors when it comes to the point of you putting together your own deals and you starting to treat your investors a certain way. Because it has really allowed me and kind of helped me and our group to be able to shape how we communicate with our investors, how we treat our investors, and it's very important to be able to have that kind of background knowledge of how you want to be treated. And so starting as a passive is a great way to do that, especially if you're working a 9-to-5 job right now, and maybe you want to kind of get yourself to that point, start to do some of that passive investing, and then get to the point of being able to do the active investing, along the way, is especially if that's what you want to do. But I know a lot of people are working those 9-to-5 jobs, and they just want to be able to passively invest till they get to a certain point where they've already replaced their income. And I know several of our investors have been able to do that on our end, where they've been able to put enough money into multifamily investments, and it has replaced their current income, and they've been able to exponentially grow their portfolio. And it's not one of those things that you're just going to invest today and tomorrow you're going to have that kind of cash flow, unless you have enough money, right? I mean, obviously you could put enough money into multifamily to do that, depending on what your income is. But it's one of those things where it might take some time to be able to build that passive income up, and you never know. You might get into this passive income we start to receive the passive income from investing into multifamily, and just realize, I kind of like this. I kind of like, giving some good trusted operators that I know, like, and trust some of my money, and having them help me grow that and exponentially increase my cash flow so that you can eventually get outside of that 9-to-5. And you never know. You might just like it that way and not have to put them together. And so one of the other things that I would also kind of talk about too in the same realm about kind of a strategy behind it is, a lot of times you think about active investing, and you think, oh, I'm just going to use my own money. And the problem with that is that if you get into multifamily, you're using just your own money, you're going to be limited, because we all have a limited amount of money that we can invest inside of these investments. And so you're going to be limited on the amount of money, the size of an asset that you can acquire. But when you do these active investments, or you're investing passively, you want to be thinking about trying to bring in outside investors to be able to help you. But as an active investor, being in your first syndication or trying to put together your first deal, investors have to, we talked about earlier, they have to know, like, and trust you. And so a lot of investors, because you go, oh yeah, I have a lot of people in my network that are high net worth and are accredited and they have lots of money, and they can invest inside of my investment. The problem is that they might know, like, and trust you, and they might know, like, and trust the deal you've put together, but they don't know, like, and trust you in that deal. And so a lot of times it's going to be hard for you in that first syndication to be able to raise that money, unless you can align yourself with somebody else and allow them to be able to help you and train you to be able to, build your credibility by having them come alongside you to be able to bolster that.
Great, thanks, Dan. So let's talk a little bit about the outlook for multifamily. We've talked about it. We hear there's a recession on the horizon. So Michael, tell us, what is your outlook for the market?
Yeah, it's a question. I'd love to hear Dan's perspective on it as well. Yeah, it almost feels like we're due for a recession, right? Because we haven't had one in a while, and it just seems like, gosh, we're due. And some people argue that this bull market we're in is actually the weakest bull market in history. I'm not an economist, so I can't attest to that. I'm just watching things like, multifamily prices, residential prices, and the stock market. And looking at the interest rates, for example, the Fed hiked it 4 times last year, which we felt it was a full point, and it kind of wreaked a little havoc in the market when that happened. And then they were going to do something similar again this year, 2019, and in December they backed off and said, "Oh, we're going to hold off." So all of a sudden, instead of the interest rates going up, we're expecting, a flat interest rate. In fact, it seems like they've gone down a little bit. We're getting sub 5% more interest rates again. Even when the interest rate was going up quite a bit, actually, in a short period of time, we did not see prices move at all. Like cap rates actually stayed the same or went down. So prices were the same or went up. And the reason for that, my impression is there's a lot of demand for multifamily because the asset class is so attractive. We talked about some of the benefits of it, and there's a lot of money on the sidelines. People are scratching their head in the stock market going, this can't be it. I just can't deal with the volatility, uncertainty. Where else can I put it? Oh, I get it. I'll put it in multifamily, right? So we have a lot of people with money. We have a lot of people with 1031 exchanges. Dan mentioned that before. And if you 1031 exchange, you can sometimes save hundreds of thousands of dollars. And if you can save hundreds of thousands of dollars in taxes, you might be actually pay a few $100,000 more for a property just so you can do that. And we're seeing a lot of that. We're seeing a lot of foreign money coming into the U.S. And a lot of the foreign money doesn't really care about return. They just want like stability. So we're seeing a lot of demand for multifamily. And my outlook for the next 12 to 18 months is that interest rates are going to be flat. And even if they do go up, which obviously at some point they must somehow magically they go up because it's so low, the demand for multifamily is still going to keep cap rates relatively low. My outlook for the next 18 to 24 months, 12 to 24 months is relatively flat. Dan, what's your perspective on that?
I actually had an investor reach out to me on Saturday. We had a phone call on Saturday because when you're doing these active investments, you take investor calls whenever you can, right? And so we had an investor call with this gentleman, and he had been through 5 different cycles. And I asked him this very same question. I said, what do you think is going to happen with the market right now? And he said, he goes, Dan, because I've never seen in all my life a market that has gone this long without some sort of a correction. And he said, I honestly don't really see anything in the market right now that's really pointing towards it. There is going to be a downturn. And so he said, obviously, the interest rates is really the only thing you look at. And so right now they've kind of held them steady. And, our group just closed a $16.5 million project a week and a half ago, and we got the best debt terms we've ever had. So we actually got a 30-year amortization, 10-year fixed Freddie Mac loan with 5 years interest only at 4.01% interest, which is just unheard of. It's just phenomenal. And a lot of that has to do with the strength of your group and the type of the assets you're buying and the location you're buying them in. So it really just there's a lot of different factors that play with that. But I kind of agree with him and just basically look at this and go, we've been talking about this, a downturn or this correction in the economy. If you look back historically since 2015, there's been a lot of people that have just sat on the sidelines and just not invested because they're just waiting for this downturn. And right now they're looking to see what the last 3 years did, the last 4 years, and they're wishing they didn't just sit on the sidelines. So, the final question I'd like to answer is should you as a passive investor, or if you're looking to do active investments in multifamily, should you wait until the market drops in order to do that? And I would say no. I said I think you need to do some things to mitigate the risks of a potential downturn. And some of the things that we do in our group is we try not to over leverage ourselves on our properties, and we also make sure we have enough in operating reserves in place so that if for some reason there is that correction coming up, or when it actually comes, we have enough to hold through that cycle. Because those people who had properties in 2008 that had enough in operating reserves and had lower leverage, those are the properties that they were able to hold through a downturn, and they did really well on the exit on the other end of that turn.
Michael, tell us what can good operators do to protect investors in a market downturn?
Yeah, I think Dan mentioned some of them really, really critical, which is sufficient reserves. And so the good operators, when you're looking to invest, you look for some of these things. One is how much cash do they have in reserves when they close? That's really, really important because there's so many things that can happen that are unforeseen. And if you don't have enough cash, that's going to get you in a lot of trouble. Also, our reserves being held out of cash flow. So as the property is being managed, is the reserve is it being grown out of cash flow? That's also very important. Dan mentioned debt as well. I think a leverage debt, the other thing that's important in that regard is long-term debt, right? So if you have a 10-year loan on it, even though if the business plan calls for a sale in year 5, which is great, but what if crap hits the fan in year 5, right? Well, shoot, okay, maybe we can't sell or we shouldn't sell, but we have the 10-year loan so we can ride it out. The other thing that's very important is cash flow, right? We don't buy stuff just because we hope it's going to go up and we can sell in 5 years. No, we buy stuff for cash flow. And if we're doing a value add deal, it maybe doesn't have cash flow we want right now, but it better have it in 12 months from now, like lickety split, right? So we're not buying stuff that doesn't have any cash flow. So all these things together really protects the investor from a downturn. And really the worst thing that we want happen is that we can't make as much money as we project because we can't sell in year 5. Like in my mind, like that's the worst case. That's what we want the worst case scenario to be. Okay, so we wait, hold on another 2 years. So it depresses your IRR by like, 0.25%. No one's going to be upset over that because we had to ride it out another 2 years. So those are some of the things that we're all collectively doing to protect all of us from a potential market downturn.
So we're running a little short on time. I want to definitely leave some time for questions at the end. So let's just do this. Maybe have each of you share some parting guidance, just something, brief, and also what are some next steps to connect with each of you. So maybe Dan, would you start?
Sure, yeah. So, I think that, as a passive investor, one of the most important things you can do, even though it might take a little bit of time, is to become educated and more educated in this space because, the more you can become educated, learn how the underwriting and the financial analyzing works. You don't have to know it down to like the nitty gritty, but to at least be able to understand what numbers affect which numbers in the underwriting and how those different things work, and making sure you have certain rules of thumb in place about, various, entry and exit points whenever you're inside of these types of investments will help you feel more comfortable when you're making some of these investment decisions as far as which deal to get into and which operators to align yourself with. And also make sure you do some interviews with these operators and make sure that they, are aligned with you. Make sure that they have, your best interest at heart because, you want to make sure that if you're going to be giving them hundreds of thousands of the dollars that you have earned over the years, that they are protecting it like as if it is their own. And I think one of the best things you can do, Michael has a program that, you can learn some of these types of ins and outs of, how to do this multifamily stuff, whether you want to do it just passively or if you want to do it actively. I think it's important for both sides, active and passive, to become educated on that. And then obviously, a couple of ways that you can reach out to me if you're interested in investing alongside us and our group. Our group is called passiveinvesting.com. I know it's a website, but that's also our group's name. So our brand is just passiveinvesting.com. You can go there, see some of the acquisitions we've had, and also look at our group and our other 2 partners, Danny Randazzo and Brandon Abbott, that are on our team. And then you can also on there, there's a form you can fill out if you're interested in possibly investing with us on one of our future projects. We don't add you to our investor list right away. We want to make sure that you're a good fit for our group. So when you fill that form out, you'll like to get my assistant will call you and she'll schedule a personal one-on-one call with me, and I'll talk to you about your investment goals and see if our group's a right fit for you, because it's very possible that we might not be a good fit for you depending on what your goals are and what you're looking at, and so we can help guide and direct you in that way. And then of course, some of you who have been coming to this webinar from my Multifamily Investor Nation group, I don't do things like Michael, so I'm not doing coaching or mentoring or anything like that. I'm just providing a lot of content and value, and we have meetup groups across the country, and really just trying to provide a lot of value to the multifamily group across the country. And so you can join me over there if you'd like. You can go to multifamilyinvestornation.com. We also have a summit that we do twice a year called the Multifamily Investor Nation Summit. Michael's actually going to be speaking at that one, so you can go to mfinsummit.com to register for that. And I think we actually have a promo code. I didn't even think about doing this, but you have a promo code, Mike, to actually, Michael actually talked about to give them $100 off their ticket, don't you?
I do. I think it's just Blank, B-L-A-N-K, but I'm not 100%
I think
sure.
it is. If it's not, just use the promo code webinar and you'll get it. But Blank should actually work, B-L-A-N-K or Blanc, whichever way you want to say it. I know the right way to say it's Blanc, but for spelling purposes, just BLANK, and you can get that $100 off. But I want to thank you, Bronson, as well as you, Michael, for having me on tonight and allowing me to be able to share some of the knowledge and allowing us to be able to collaborate on this particular webinar. And thank you for those of you who are listening and watching, and all the feedback you're providing. Looking forward to some of the questions here in a little bit as well.
Thanks, Dan. Michael, how about you?
Yeah, I think Dan mentioned a lot of good things. I think education is key. I think getting out and meeting operators and even other passive investors is key, because it allows you to ask questions and look at potential deals and really get to know the operators, right? Because if you find a good operator, you don't need a dozen operators to invest with. You need like 1, 2, 3 strong ones, right? Once you find those people, you can trust and rely on the fact that they're going to do a good job, they're going to buy right, they're going to manage it right. So just get to know your operators, meet them wherever they are. If they have live events or in some way, just meet them and get to know them a little bit. Just make sure you don't just chase the yield, okay? I see a lot of mistakes being made when they're just chasing the IRR, the cash on cash. First of all, it doesn't take into consideration how they're underwritten or analyzed the deal for reasons we just said. It also doesn't take into consideration the operator, okay? You can go, I would argue that a lower return with a strong operator is much better than a higher promised return from someone who's just getting started, for example. So don't just chase the yield, okay? Apples is not apples. You got to look at each deal as it goes along. To connect with us, our company is called Nighthawk Equity, and you can go to nighthawkequity.com. And we're actually, there's also, just saying the same, the process is very similar to Dan just described. You can join our investor club, and you can schedule a call with us, and you'll actually talk with Brunson. We'll get to know each other, and we'll see if there's a fit. And that's kind of how we work as well. And we have an event July, Dealmaker Live, end of July 26, 27. It's and Dan, in fact, is speaking there. Brunson is speaking there as well. It's a great opportunity to meet me, Dan, and other operators as well at Dealmaker Live. That's you can go to themichaelblank.com/event to grab tickets for that. So those are some ways that you guys connect with us and with Dan. Dan's a great operator. We've known each other for a while. So a great way to have 2 operators right here on this particular call that you can reach out to, get to know a little better, and consider investing with.
Awesome. Well, gentlemen, we're going to go ahead and open it up for questions. So if you have a question, go ahead and type it into the box. Like both of them said, Dan and Michael said, we're constantly looking at deals, constantly doing deals. So if you're a passive investor, you'd like to connect, please reach out. We'd love to hear from you. I know Dan and his team would love to hear as well. So look forward to that. So we'll take some questions here. So go ahead and type it in the box. Looks like we have one from Antonio. It says, sounds like you need a lot of cash to be a passive or active investor. How can you build a network of investors just getting started?
I mean, I can tackle that one, Michael. I think, for somebody who has not a lot of money to be able to invest right off the bat, whether you're being active or passive, obviously from a passive standpoint, if you're wanting to invest passively, you're going to have to do something to be able to increase your income, right? To be able to get that cash, cow pot somewhere that you can invest. But, one of the biggest things that from an active standpoint that you can do is to start to go to events like Michael's event coming up here in Dallas next month, and really being able to surround yourself with people who are higher net worth and that can help lift you up and bring you higher up in your network. So if I think it's a great idea to go to events like Michael's event and like these RIA clubs and these meetup groups that my group puts on and stuff. But one of the things I always teach is that as a active investor who is trying to find other investors to invest alongside you, one of the best things that you can do is try to put yourself in environments and in rooms of high net worth investors where you're the only one looking for that money. You're the only one looking for investment dollars, because when you go to RIA clubs and things like that, you've probably been there before, and the one guy walks in the room and he's kind of got some money, and so it's like a fat rat on a Cheeto, and everybody tries to pounce on that one person, to be able to get them to be able to invest in their next deal. And so, I want to make sure I'm in an environment where I am the only one looking for that money. And one of the things you have to always understand is that, Michael and I didn't just start this stuff overnight. We have been building relationships with people, and when you talk about trying to find investors, you have to build relationships. It goes back to what I first talked about know, like, and trust. people think that trust and like are the most important things, and they are important, but people have to know you. So you got to get out there, get them to start to know you, because once they start to know you, then they have that opportunity to make that judgment as to whether or not they like or trust you. And it might take more than just one touch with them to be able to get them to like and trust you. So you have to continually show up, continually be able to educate people, and be able to be out there to be able to find that, be able to find those investors. And so there's a lot of other opportunities to be able to find investors. But hopefully that'll help you and give you a little bit of a tip there on how to find the next investor for your next deal.
So, Michael, I have a few questions here. I can kind of tie them into one. So somebody's asking, do you have to be accredited? And also, what's minimum investment and how many years is money tied up? Obviously, we're not offering any specific deal, but maybe you can just kind of talk about that. Like, does someone need to be accredited? Maybe people don't understand what that is. What's minimum amount? What is a normal kind of time frame for these investments?
Yeah, you don't have to. Well, it depends on the type of offering. You have to see what kind of offering it is. For many offerings, you don't have to be accredited, and accredited means you have a net worth of $1 million and an income of $300,000. And if you're accredited, it makes everything's a lot easier. Okay, you can invest in almost anything. If you're not accredited, things are a little more difficult, but it's not impossible. So both Dan and I work with non-accredited investors. It does require getting to know each other and phone calls, emails. Before we can, and then there's got to be a fit, and we have to determine that you have some level of sophistication and familiarity with real estate investing. In other words, it shouldn't be the first time you invest in real estate. It shouldn't be your last investment you have. Typical, I think the other question was, what is your minimum investment? Typically for our investment is $50,000 and higher, with preference given sometimes to people who can invest a bit more. So those are some of the parameters to think about when you're investing.
Great, thank you. Dan, question for you is, can you talk about maybe student housing versus multifamily housing, kind of how you invest in those two different, do you see those as the same? Do you see them different? Kind of pros and cons going into that?
Yeah, so I mean, I don't have any experience investing in the student housing sector. I've done a little bit of research on it, but to date, I have not invested in any of the student housing. And it definitely, I think, has its own asset class in and of itself, because not only it is similar to multifamily, I think, because you are renting out an actual unit, but a lot of times you're renting out beds, not units, and so it's a little bit more challenging. So I can't necessarily speak to that because I don't have a lot of experience with it.
Okay. Michael, this is a question: do you always invest in your own deals?
We try to.
Cool.
Not always, but most of them, yes.
Sure. Okay, so I see a few more questions. I'm just going to go through these. A question comes up. I think this is about, I'm just going to read this from Eric London. What would you suggest doing for 1 to 2 years before you can switch over to an active full-time GP? I think the question is maybe some action steps someone can do if they're hoping to become an active kind of general partner syndicator. What are some things they can do in the meantime?
Well, I mean, a variety of things. One is, obviously, if you want to be an active investor, you definitely have to invest in your education. So we have programs for that. There's other people who have programs. Find someone you resonate with and just start going deep with them. Take the online classes, take the mentoring, attend their live events. You definitely want to invest in your education. If you want a way to bridge that gap is to possibly passively invest in a deal. And maybe that way you can look over our shoulders possibly and participate in maybe the property walkthroughs and that nature. So passive investing could be a bridge as well into active investing.
One of the other things that I'll kind of dovetail that question with is, all of the education, what he's mentioning too, is definitely what I would suggest as well. And, also, joining and subscribing to some podcasts that can provide you that constant motivation and that constant, not just motivation, but the constant content and education. The motivation I'm talking about is more or less like hearing other people closing deals. And that's one of the reasons why I put together my podcast, which is, it's called the Multifamily Investor Nation podcast is what it is, but we only interview people who have actually closed deals. And so, we're on iTunes and all the other platforms that you've probably heard of Michael Blanc's podcast, but, on that podcast, we really kind of it's a weekly podcast, but only people who are actually closing deals do we interview on there. So if it's just an expert and they're not closing deals, we don't interview them. So we only want to interview people who are everyday people closing deals, and we go down to the nitty-gritty with them about how they found the deal and how they financed the deal and how they did with working investors and where they found them, and the return projections and stuff like that. And so it'd be a very good educational piece to kind of subsidize even some of the content that you have as well, Michael.
Yeah, that's right. Your podcast is a great resource. Obviously, we have one as well called Apartment Building Investing, and another a great resource is the book that last year, which is called Financial Freedom with Real Estate Investing. Kind of shows you the roadmap to closing your first deal and kind of helps you visualize what that process is of active investing as well.
Let's do one more question here, and then we're going to kind of ask how we can connect with you guys again. But this is from Joe. Do you recommend self-directed IRAs for investment purposes in multifamily? And either one can jump in here.
Yeah, I would say yes, I do. I mean, I have about every deal we've put together, we have probably about 20 to 25% of our investors are investing via their self-directed vehicle, whether it be a self-directed 401k or IRA. So I think it's a great vehicle to be able to invest in these types of assets, especially because as you're putting deals together yourself, one of the things that we've seen in our group is we have. If you go to the mfinsummit.com and you look at the speakers list, we have a lot of our speakers that have actually joined us on some of our projects because they have some self-directed money that they can invest in their own projects that maybe they're putting together themselves, but they want to, be able to use that self-directed money and that and a passive real estate investment is a great vehicle for that.
Great. Well, gentlemen, we're kind of getting to the top of the hour here. I want to thank you for joining today. I love this collaborative process we can do together, and as we help each other, the pie gets bigger, and we can educate all kinds of investors everywhere. So, can you just share real quick how folks can connect with you?
Sure. I'll meet you. I'll go ahead and start and let you wrap it up, Michael. So obviously, I'm Dan Handford again, and you can reach out to me by shooting me an email. If you have any questions for me, you can shoot me an email at dan@passiveinvesting.com. If you're interested in investing alongside of us in some of our projects or starting a conversation with our group to see if we might be a good fit for you, you can go to the passiveinvesting.com website, fill out the investor form there. Would love to be able to jump on a phone call with you. And of course, from the Multifamily Investor Nation, just go to multifamilyinvestornation.com. You can join our email list there, and also the mfinsummit.com using promo code BLANK, BLANK, and get $100 off your ticket for joining us at the summit later this month.
Yeah, and if you want to connect with us, we are at nighthawkequity.com. That's nighthawkequity.com, and just click the join button and just complete the questionnaire, and that'll start the dialogue. And then you'll end up speaking with Brunson, and we'll see if there's a fit. So that's the way you can connect with us.
One thing I want to mention real quick, guys, is you guys are both going to be speaking at Dealmaker Live in July. So July 25th through the 27th in Dallas. If you have not signed up as an investor, as a passive or active investor, if you want to find deals, you want to invest passively, you're an operator, any of the above, you're going to meet 500 plus people. It's going to be amazing, and both Dan and Michael will be there. So hope to see you there as well. You can reach me if you want to email me, Bronson@nighthawkequity.com. It's been my pleasure to host this. Really enjoyed spending time with you guys, bettering yourselves.
Thanks for having me.